I suggest your starting point is probably going to be to look at share options. Now, what that involves is an employee or more than one selected employee being granted the right to acquire shares at a future date or from a future date, paying a fixed price, which is normally equal to the share's value when the option is first granted. Now, an option is a right to acquire shares, but it doesn't mean the employee has any obligation ever to do so. So there's no risk for the employee. If your company does well, then the value of the shares should grow in value, which means that they'll be able to buy shares at a future date at today's price. In other words, with a discount. If your company qualifies, and I'll explain in a minute what that means, your starting point is probably going to be to look at EMI options, which carry some quite significant and attractive tax advantages, both for the company and for the employee. Well, EMI is aimed at smaller companies, and it's also limited to companies in certain trades. So the first thing to do is just to check that your company does qualify. The main things are that it's an independent company. In other words, it's not a subsidiary of another company. Also, that it doesn't have assets worth more than £30 million, nor does it have more than 250 full-time employees. And also, we'd need to check that what your company does, how it actually makes its money, isn't on a list of excluded trades. There are some businesses which, for policy reasons, the EMI tax incentives do not apply to. If you're not able to set up an EMI option plan, then your next best bet is to look at something called a company share option plan, or CSOP. Now, it actually works in a very similar way, but you don't need to meet the requirements for trade or size. The tax benefits for the company share option plan are similar to EMI, although EMI potentially does have the edge because it can allow an employee to pay tax eventually at a lower rate than under a company share option plan. So, in some cases, you may not be eligible to grant EMI or CSOP options, and you may feel that unapproved options aren't going to be the right approach for you. So if that situation applies, I'll run you through some of the main alternative choices. The first of which would be for employees to purchase shares. Now, obviously, they're going to have to find the money to do that, and that isn't necessarily always going to be available. One way of helping with that may be to allow the employees to purchase shares but not immediately pay for them, although they will have to pay for them eventually. A second possibility is to allow employees to receive free shares. Now, if your company is in its relatively early stages of growth, then the value of its shares may be relatively low. So if you award your employees with free shares, then although they may have to pay income tax on the value of those shares, then the amount of the tax bill could in some cases be quite small because the value of the shares isn't very high.